Hey guys, it's Crossroads here. Today we have a special guest. He is an amazing analyst, Devin Ryan, head of financial technology research at Citizens. Devin, thank you for joining me. How are you today?
I'm doing great. Yeah, great to be here, Roy. Looking forward to the conversation.
Yeah, and you and I share a lot of names in common as far as stocks that we follow. We'll talk about some that I don't as well, but I wanted to just kind of start off with a broader question on specifically crypto winter. A lot of the names that you cover, that you touch, certainly are affected by any sort of crypto winter. And so every single time it seems like that bulls are saying, well, this time it's different. There's no crypto winter here. And so I'm kind of curious on your opinion of, is there still a seasonality in crypto that's in play, a crypto window, for instance? And is it going to look any different perhaps this time than the previous cycles?
Yeah, it's a great question, and my view is that we are kind of transitioning from a period where the space was primarily speculation, right? It was what blockchains may be used and what should the value of those tokens be, and we're going to a place where you're actually going to see real utility of the blockchains, and that's going to drive the token values, and that will start to detach it from, I think, this cyclical theme that really, Bitcoin, obviously with the halvings, there's been, I think cyclicality around that, but ultimately we see that lessening. But then on top of that, the real use case of blockchain, which is to run transactions on, whether it's financial transactions or really anything else, we're at really a seismic moment for that with clarity coming, the Clarity Act, which is the legislation that's sitting in the Senate right now and progressing. That's going to really give the green light for the massive institutions, whether it's asset managers or banks or others, to come to this ecosystem. And so we're going from kind of a pilot phase, is the way I like to say it, to mass adoption. And as that happens, it's hard to see crypto winter cyclicality. It's going from kind of a speculative pilot to really kind of mass adoption. And as that happens, I think the volatility of the asset class is going to decline. I think the tokens that are actually getting used, you're going to see that fundamentally, and ones that aren't, you're probably going to see less value in those. But that's what's exciting to me, is like the technology is actually transitioning to a point where it can be used, because up until really now, there's been a lot of roadblocks, or even there's been negative legal consequences for companies that have been trying to engage in the space. So I'm not too concerned about that. I know we're kind of in this volatile moment, but we're kind of transitioning from pilot phase to mass adoption, which is really exciting to us.
Yeah, it's really exciting for me to see it move from just mostly Web3 and into actually real world finance. And of course, you're centered in a lot of fintech names that see a lot of those first impacts in those early reads as well. So it's interesting just to see that pivot, and also at the governmental level as well. So on the crypto winter, then you're not saying that that seasonality is completely dead or gone away with, but over time that it sounds like that perhaps it'll be less cyclical, and maybe the winters will possibly be less harsh. Or
yeah, so just like any this is an emerging frontier asset class. So you think about when maybe equate it to creating the next drug to cure cancer. When it's kind of in the idea mode and in the lab, it gets investment dollars to start to create it. But really, at that point, there's no, it hasn't been developed. There's no commercialization. The commercialization path is very uncertain. But as you kind of progress through the commercialization path, you de-risk it, and you're kind of monetizing it. And so as it ultimately gets to a place where it gets commercialized, then there's kind of real value, and the volatility declines. And so I think of it this kind of similarly, where we're in the first or second inning of this asset class, and it's been purely speculative today because there hasn't really been at scale kind of use cases on the blockchains. But stable coins are a good example. Stable coins, we got the Clarity Act, or excuse me, Genius Act was the first piece of legislation that the president signed in July. And stable coins have been growing pretty rapidly, and we're still in the very early innings of those. So today there's $315 billion of market value in stable coins. Just in the summer when it passed, it was $250 billion. So it gives you a sense of like the step function that we're already seeing in a few months here. And I think you're going to see that more broadly with tokenization. But like, again, we're at the frontier of this. So when you're monetizing an asset from the very early days, it's just definitionally going to be extremely volatile. As it scales and gets to more wide-scale mass adoption and the blockchains are being used and there's real demand for, let's say, ETH. It's not just speculative demand around, will Ethereum's blockchain be used, but real users of ETH, which are going to be, banks and asset managers and other financial institutions that need to run on the blockchain. That's going to drive the price. Just like in a commodity like oil, when the commodity markets were, essentially being created, you had a lot of speculation around them. The market structure eventually developed where you have, speculators, you have hedgers, then you have the real end demand for oil, airlines and the transportation industry more broadly. And so ultimately, all these players come together to drive the demand for the commodity, but it's not just speculative demand, it's real demand. And I think that's what's changing for these tokens, is that the ones that have real opportunities, use cases of blockchain, they're going to see real demand. That real demand is going to define the price. And then you have to look at each token has their own tokenomics. But not to go too far in the weeds here, but I think Ethereum is an interesting one because there's 120 million ETH outstanding right now. There's an inflationary aspect. So as validators validate the blockchain, that inflates. They're given ETH. So that creates inflation to the number of ETH outstanding. So 120 million, in theory, could go higher. However, as Ethereum's blockchain is used, you need some ETH to do that. So the ETH is a token to power the blockchain. So for every time ETH is used, some portion of that is burned, meaning bought back. So the 120 million, just as I think about a company with 120 million shares outstanding, that 120 million could start to come down pretty materially as the demand for Ethereum's blockchain increases, because every time it's used, some ETH is put into it, and then some ETH is burned or bought back. So that creates kind of a supply. The demand is going up, but the 120 million shares or 120 million ETH are coming down. So in that scenario, if you were to equate it to a company, that would generally be good for price, right? So supply coming down, demand going up. And that's, I think, as you think about a commodity equilibrium price too, you can equate some of these same principles. So, I think that we're just, again, we're progressing from this really speculative. I think this might be exciting to let's now, as a fundamental analyst, let's go look at how much the blockchain is being used, what is it being used for, how it's scaling, and that will help us determine what the right price should be for each token across each blockchain. So anyways, long-winded answer to your question, Roy, is I think we are detaching from the view of, this is all cyclical, speculative, to here's a fundamental viewpoint around what each token should be valued at based on what I think are the real drivers, supply and demand.
And I love what you touched on, especially there with Ethereum too. And I think that's been a lot easier for people that are not so deep into crypto to understand the thesis, just because you have the staking yield and that translates, to something kind of like a dividend. You have a float that, a lot of people don't realize this if they're not following Ethereum, but it's been largely flat since the end of 2022. Of course, you have a lot of network upgrades, if we saw an upgrade this week. And a lot of institutional adoption too, just because it's decentralized and so forth. So yeah, supply demand. And I noticed one of those names that you started covering fairly recently was one of these digital asset treasuries, specifically SBET. I'm more focused on BMNR as well, but on this, as far as the digital asset treasuries, I want to ask a couple of questions here. But first, is this mostly related to what's happening in stablecoin fueling Ethereum, and that's why you're looking at the digital asset treasury, or are there other things going on that you think is really driving this momentum towards this?
Yeah, sure. So maybe to step back, and I didn't really fully introduce my background to your audience here, but I'm obviously a research analyst. I work for a bank with JMP Securities. Now it's Citizens Bank, and my history is covering financial institutions. So I started my career over 20 years ago covering banks and investment banks and wealth managers. I covered the large investment banks through the financial crisis. So I've seen kind of the regulatory world evolve firsthand and how financial infrastructure and market structure has evolved and been upgraded over the years. But as time has gone by, I've also gotten really interested in the fintech landscape and how technology is integrating with the traditional financial system. And that's where, we got to learn about and meet companies like Robinhood in their early days, and, covering firms like Schwab and E-Trade and Ameritrade. There was a lot of cross connectivity, but I was also seeing these kind of mobile first platforms come to market with just a different speed, but also meeting customers where they were at the time, which is on their phone versus in a branch or on their desktop. And so it's kind of right place, right time. And so kind of following this transition of financial technology and direct-to-consumer financial integration to then this next wave of what I think is going to be really exciting is how blockchain is integrated, and these new technologies kind of upgrade the financial infrastructure. And so we've been on this theme for probably 7 or 8 years, to be honest, but like now is finally, I think we're at the point where it can be integrated because you're getting the rules of the road to bring in these tens of trillions of dollars of asset managers and all the big banks and investment banks and market structure firms, the exchanges, and everybody realizing like, hey, and payment firms, if we're not engaging with this technology that allows transactions to happen 24/7 for very low price points and all the other upgrades that provides the financial system, we could get left behind. And so I'm seeing that play out. And somebody that's coming from kind of a regulated market structure background, I think I have a little bit of a unique lens. I'm not approaching it from, kind of the pure speculative part of the technology, but it's like, what can we fundamentally get done here? What are the steps that need to occur? What regulation has to get passed? What legislation is going to be required to get all this done? And what regulator is going to be involved in this? And what do they typically allow? What do they not allow? And so that's where I'm coming at this from. And so as we've gotten to ideas, I'd say arguably early, we have been obviously bullish on Robinhood. We've been bullish on some of these other names where I think that requires looking out a few years. You have to kind of look out into the future and say, where's the world going? And then how do I position for that? Because some of these themes are going to take 5 to 10 years to really unfold. But if you see the direction of travel, you can position for that. And as an investor, kind of that point around like investing in Ethereum, the token, when it's all speculative, it's going to be volatile because we're in the first inning of monetizing something that could be really big. And I'm not, we'll see which ones are the winners. But it's the same thing here. So our view is that this is kind of the next frontier. It's going to be integrated in blockchain as a technology, just like artificial intelligence as a technology will be integrated into the transactional workflow of virtually all aspects of financial services. That's my thesis. I may be wrong, but that's my thesis. And so based off of that, then what does the world look like if that plays out? And so that then kind of, as you progress to that view, then you say, okay, well, who are the leaders in that right now? And so you'd say, well, right now, Ethereum's blockchain has by far the strongest network effects around adoption of blockchain technology. Now, again, we are in the first inning. Everything is in pilot phase. Nothing is really institutionalized yet. Everybody's testing stuff, but this isn't what it looks like. What it looks like is it's integrated into the backbone of payment systems, into trading. All assets are brought on chain. They're tokenized because you can move them like water. There's no settlement time. They can move 24/7. That is a massive upgrade to the financial system. And so in that happening, we think that there will be winners of that theme. And so that kind of led us to SharpLink as an opportunity. One of the opportunities of that, I think there will be other opportunities, but as I think about the treasury strategies, I think they've kind of all been lumped together and they've kind of gotten a bad name, which is undeserved. Now, I don't think that each asset or token needs to have hundreds of treasury strategies, but each token could have several that have a very valuable place in the ecosystem. And what I mean by that is the treasuries that have kind of some type of management expertise to be able to drive value above and beyond what investors at a passive level. So if I'm a passive investor in ETH, the token, can the treasury team substantially outperform that token's value appreciation over time? And what other type of operating earnings can I get? So when I look at a company like SharpLink, my view is that this business should be whatever you think ETH is worth. SharpLink should get a pretty healthy premium to that, because the founder of, or the chairman of SharpLink was a co-founder of Ethereum's blockchain with Vitalik. And so Joe Lubin knows Ethereum, in my opinion, better than virtually anyone else in the Ethereum ecosystem. And he also founded Consensus, which is a private company which is building essentially networks around Ethereum's blockchain. And so they have a pole position to understand where Ethereum's blockchain is going, what the most exciting use cases are, and then how to leverage one unit of ETH or one token of ETH to drive incremental value above and beyond what I could or you could, Roy, as an owner of ETH. And so if someone can do that over time, they're going to get a premium to what somebody else could get as owning one and having it in a passive structure. So right now, all these DATs, treasury companies, are getting treated as if they're just something worse than the actual underlying asset. And in reality, the good ones are going to, over time, get rewarded as if they're adding value, assuming that they can add value. But I think that SharpLink has a very strong position. Now, you mentioned another one that has very good, like they're winning on liquidity, and liquidity is important. Yeah. So as an analyst, we look at the fundamentals of a company. But one thing I can tell you is that companies can have the best fundamentals, but if they have gates up to restrict investors from being able to invest in them, then they're going to have issues with their valuation. I'll give you an example. I covered the alternative asset managers through their history, companies like Blackstone and Apollo, great companies. Forever, these companies, after coming public, traded at very low multiples. They're growing earnings at 20-30% a year, and they're trading at PE multiples at like 10 times. And you'd say, well, that doesn't make sense. And the management teams, Steve Schwartzman saying, this doesn't make sense. And that's true on paper based on their fundamentals. But the issue was that they were initially set up when they came public as publicly traded partnerships. So under that structure, it made it very hard for institutional investors to buy them as a publicly traded partnership, because it created all these back office issues. Their accountants within their firm would give them a hard time because they'd get K1s and all these other complications around owning that stock. So there's a very high bar for these institutions to own them, if they could even own them. In the late 2019, 2020 timeframe, they all converted to C corporations, which got rid of the accounting complications. And as that happened, their PE multiples, the business model stayed the exact same. The PE multiples went from 10 times to north of 20 times, just simply because they opened the door to all this institutional capital that wasn't able to buy it. And so that, to me, it's like, why are the, we've been bullish on what the ETF effect is going to be of Bitcoin and Ethereum. It's simply, covering financial advisor, wealth management firms for 20 years. That's $30 trillion of assets in the United States that are in the financial advised ecosystem that have effectively been shut out of owning crypto because they need to own it in a compliant way within their own custodian. And so before the ETF wrapper, they couldn't buy anything crypto, or nor would they recommend it, because it's not in their best interest to do it. Once you put the ETF wrapper around this, you've now opened the door to $30 trillion of additional capital. And so that's been a big part of why valuations have gone up. And we're still in the very early innings of that. Very few wealth management firms have kind of broadly opened the door for their advisors to be able to buy the asset class. We're only incrementally going in one direction, in our opinion. So that's going to be another big demand function that's just early into how much it's baked into the prices. So I'll stop there. But I think the being able to allow liquidity and bringing it back to BMNR is that they've created now a liquid stock because of the amount of ETH that they own. So I think that's very good for them. And that, as an institutional asset, having that liquidity is important, because now institutions can come in and out of that. Whereas, and I think SharpLink is the same thing, some of the other ETH strategies may not get the same premium if they can't get liquid enough for institutional capital to be able to access it.
Yeah. The digital asset treasury, it's interesting just to see, your coverage on it's been great on SBET. But and some analysts have covered, some BitMine, some ETHZilla, some other names as well. And it's a little bit odd just looking at this, because a typical stock, if it's trading at a premium above where it should be, so that's, the premium, the MNAV, or that's normally like, oh, that's not a great thing. It might be overvalued. Like here for SBET or for BMNR, it's like, no, this is great because they're taking their stock, they're buying more Ethereum. And so it's like, it's flipped. And then I know some short reports have come out against this strategy, multiple different names, multiple different shorts. But part of it was revolving around competition, saying, hey, there's a lot of competition here. This isn't good. They can't all survive. And well, the competition is buying more ETH, which is like, that's wonderful. So competition actually helps you. It's like, it's just kind of an inverse of a typical way of looking at things. So
yeah, I mean, ultimately, this will just boil down to primarily, can the management team add value above and beyond what the passive representation is of that token or asset? And if it can, it deserves a premium. The degree of which it can on a risk-adjusted basis will dictate what premium it deserves, with liquidity as one additional, liquidity and ways to generate value by being smart capital allocators. Can you issue creative capital structures to be able to buy at certain prices and lock in? And I think that's one of the things that strategy has been obviously doing. I'd say thus far, the Bitcoin DATs are different because they're not really leveraging the Bitcoin yet to drive incremental value. I think that'll be something interesting to watch. As you accrue a lot of Bitcoin, can you actually create operating earnings around it? And then if you can, then all of a sudden you go back to the conversation of, this shouldn't trade at the representation of the passive. It should trade at a premium to it if you can generate strong operating earnings from the asset that you own. And so that's my view around what SharpLink will be able to do with Ethereum. I think they are in a very good position to understand how this ecosystem is evolving and how can we optimize earnings off of the ETH, not just staking. If it's simply staking, then you're kind of bumping into the equivalent of what I can do as an individual owner of ETH. So that doesn't necessarily drive a lot of incremental value. But if I can take one ETH and on a good risk-adjusted return, generate additional percentage points of yield, asset yield on that, that is now very valuable because I can't do that. And I think that's what these leading strategies are going to do, and what a lot of the institutional short reports aren't really putting a lot of focus on yet, or probably don't even fully understand that this is kind of the path that we're going to. This is a operating asset that will have potentially operating earnings power on top of it. And then ultimately, as an investor, you have to assess, are they taking good risks with that asset? So, what you don't want to see is if I have one ETH and I go lend it out and I generate a 25% yield on it, but it's very risky, I would have to assess that. Is that a good decision with the ETH versus if I can do something would generate an extra 2 or 3% yield on it relative to the staking yield? That may be on a risk-adjusted basis very compelling. And I think that's what this is going to come down to. But we're in the, this is like the first inning of the game. And I don't think a lot of people fully understand what even the asset class is, why it exists. And that's the opportunity for investors. It doesn't mean that all blockchain wins. It doesn't mean that all tokens are going to be successful. This is like internet 1998, 1999. There's everything's .com, but then over time, things consolidate to the leader. So my view is there will be a lot of blockchains, but there will be dominant blockchains where the vast majority of financial transactions happen. The vast majority of Web3 transactions happen because they're faster and they're they're not quite as secure, but they have better throughput and speed, or they're more aligned with being able to do things with an AI agent. And so there's not going to be one winner of blockchain, but the point is there will be a lot more activity overall on blockchain as we get the regulatory clarity. You've got firms like BlackRock that are literally writing articles. If everyone didn't read in The Economist, Larry Fink, the CEO of BlackRock, and Rob Goldstein, the COO of BlackRock, put a op-ed out earlier this week on the fact that they believe all assets are essentially getting tokenized and brought on chain. BlackRock has north of $10 trillion of assets. Then you take Fidelity, you take Franklin Templeton, you add them all up, and you're at like $50 trillion of asset managers want their assets tokenized. So if these asset managers want their assets tokenized. Wall Street also, who works with these asset managers, needs to figure out how to work on blockchain rails. So this is all progressing, I think, in one direction, but it takes time. You need legal clarity on what it means to tokenize an asset. What is a security? What's not a security? You need to understand who the regulators are. This is not an overnight thing, but it's the direction to travel, I think, is clear. And that's what is exciting to us. We're trying to assess this frontier, and it's going to be very volatile in the early days. But I think that if you can kind of assess it and figure out who the winners are early, it's not small returns, it's potentially, massive returns.
So let me ask one more question related to digital asset treasuries. You mentioned, with crypto, or actually with most commodities, tends to be, winner take most or all. Sometimes it's one winner, sometimes it's a duopoly or triopoly. So with the digital asset treasuries and Bitcoin, that's mostly strategy, and it's dominated it. There are some that view Ethereum as the same thing, that one is going to come out as a dominant player. Others view it as multiple winners. You seem to be of that mindset. So I'm kind of curious, do you think that eventually that there's other competition for strategy in the Bitcoin space, or is it just the nature of the Ethereum network being different, maybe institutional understanding and gravitation towards it being different, and there's more optionality in what they can do just because the nature of the Ethereum chain, which is why there might be multiple winners?
Well, yeah, maybe try to answer that this way, and then tell me if you want me to redirect me. But essentially, I think in the Bitcoin, on the Bitcoin side, I think strategy is clearly the leading horse here. And again, going back to this view of like liquidity and then optionality around owning the asset, what they have not done yet is actually show they can drive operating earnings off of the Bitcoin. If they can do that, I think it's game changing, and it changes the whole valuation construct, even beyond what's already kind of a view of like they're creating access to an asset with all these different types of levers of you can buy it in any part of the capital structure as an investor, and opening the door to tens of trillions of dollars of asset managers that maybe couldn't buy Bitcoin in their mandate, but can buy strategy in some way or form or fashion, and the equity or the preferred or the debt side. And that's interesting. I think it's really interesting if they can actually drive operating earnings off of the underlying asset, off of Bitcoin. But what is very clear is Ethereum, ETH is an operating asset. So Ethereum is a working blockchain that is going to be a big player in this world of tokenizing all assets. So it's the trusted blockchain with the biggest network effects on it today that has established itself with, I think, the institutional community and with the financial community. Now, that doesn't mean that other blockchains are not going to be used. I think there will be other blockchains that win parts of the world, and then as the whole, as more assets get brought on chain, I think we will live in a multi-chain world where they fit seamlessly together. So, but I think that there will be blockchains that accrue more of the activity, and some of it will happen on the layer one. Some of it, for ETH is happening on the layer two, and that adds a whole nother complexity to the conversation. But no, I think that there will be multiple chains. There will be multiple winners. I think that ETH is very far ahead right now. And then in terms of the strategies, the corporate strategies around buying, everybody doesn't have a right to win there. That comes down to which management teams have the ability to drive value for their shareholders in a differentiated way, and the shareholders will over time assess that. It's way too, like, all the negativity on the space is getting lumped together because of price and because it's just early, and I think these companies are unproven, and that's fair. I think it's fair that these companies need to prove themselves and prove that they can execute over time and drive value. But simplistically, as a fundamental analyst, over time, if a company is going to drive operating earnings above and beyond what the passive alternative is, they're going to get rewarded for that because there's an arb in there. If they're not rewarded, then what will happen is smart institutions will start buying that asset and selling and hedging it with the with the spot asset, because they see that there's incremental value they're getting all the benefit of the spot asset plus the operating earnings, which is helping drive ETH per share or whatever the token per share faster than you would get if you just owned it in a spot form or in an ETF wrapper, if you will.
Sure. Yeah, that makes sense too. And so spinning off of DATs, I want to talk about a couple of the crypto names. So Coinbase and Circle, kind of lumping them together, and USDC, which some people are like, hey, Coinbase owns that one. Well, kind of, but not really. So you cover both Circle and Coinbase, and USDC has been there's been a lot of usage in it. You talked a little bit about tokenization. Payments is one of those things where a lot of people are very excited on that as well. And so with stablecoin, there is a thesis out there that a lot of people think that crypto and payment by crypto is just going to displace modern payments or maybe even modern payment companies. I'm curious where you fall on that thesis and what your take is.
Yeah, so I think that stable coins, they're getting all the attention now because they were the first version of tokenizing something that's kind of tangible to most people in the financial world. And so it's very easy concept, right? You're tokenizing a US dollar or another fiat currency. But it's really the tip of the spear. We're going to a world, as I talked about, in my opinion, that's tokenizing virtually all assets. So stablecoins will just exist in a world where tokenized stocks live and tokenized treasuries and tokenized money markets. And so stablecoin legislation, the Genius Act came first, and it will be in stablecoins will play a big role in, I think, payment ecosystems. It's going to start primarily outside the US because that's where the friction points are the biggest and where it's the most dysfunctional. Peer-to-peer, remittance, moving money, where there's big spreads today and it's slow and there's FX volatility. Same thing with corporate to corporate payments and money movement. But then eventually what will happen is people will become accustomed to working with stablecoins and they will see the value to them in using them. And so they'll say, well, hey, if I'm using them outside the US, and I'm a multinational company, I want to make sure my banks in the US allow me to use them as well. And then, in addition to that, if I'm a corporate treasurer and I have tokenized treasuries and I need to make payment to my vendor in Singapore, I may have a tokenized treasury 1 second. The next second, I convert it to a stable coin. It's then in a stable coin form. It then goes across the globe to Singapore. And then in a split second, that Singapore vendor can take it and flip it back to a treasury or could send it across the globe to pay somebody else. But in today's world, all those transactions have settlement lag. And so there's a lot of friction in it. And there's also a lot of cost in it. In the world of tokenizing all these other assets, T0, meaning instant settlement, is game changing because you can literally, as a corporate treasurer, earn interest on your investment account up until the very last second. A second later, it's converted to a stable coin. A second later, it's back into a T-bill. And that really changes the whole makeup of the financial system. If that's, we're not going to that in a few months. Like, this is going to take years to potentially get to, but that's my view. And so stable coins will play a role in that as a technology to make payments in a world where other assets are tokenized and people are doing more on chain. So that's the way I would frame it. For Circle as a business, they're competing with, are we going to be the leading stablecoin? Have we built enough network effects around our stablecoin? Do we have enough partnerships? Do we have a right to win in all these jurisdictions globally? And so they have a head start because they were doing this before most of the firms. Now, Coinbase, I'm not sure everybody knows this, but back in 2018, Coinbase actually founded USDC, which is Circle stablecoin, with them. So they did it in partnership. So that's why Coinbase has such a attractive unit economic with Circle and USDCs, because they founded it and they were able to renegotiate their contract several years ago. But essentially, every dollar that is generated off of USDC that Coinbase holds in their wallet, they get to keep 100%. So the way it works is you want a stable coin, Roy, you give me $1, I give you $1 stable coin. I take your dollar and I go buy T-bills and I get, call it 4%. If I'm the stablecoin issuer, now I'm making 4% off of your dollar. That's the business model. And so Circle keeps that. But then for all the dollars that are on Coinbase's platform, which is about 20% of USDC, they keep 100% of that. So that's very attractive to them. And then on top of that, they get to keep everything that is not under Circle's umbrella, that's under USDC, USDC and Circle wallets. Coinbase keeps 50% of everything else. So they've got a really attractive. So that was kind of the argument of Coinbase if you're valuing Circle at 20, 30, 40 billion dollars in market cap, and Coinbase is keeping 100% of the value of USDC on their platform and 50% of almost everything else, what is that value to Coinbase? That should be tens of billions of dollars in theory if you were just doing some rough math. That being said, Circle, over time, I think their value prop is, how do we diversify away from Coinbase, right? They don't want it to all be Coinbase. They don't want Coinbase to keep 100% of everything. How do we diversify away? But then also, how do they diversify their revenue stream? So they've built up a big network. They've got north of 1,000 partners that are using USDC. How do they get them to use their payment rails? Because Circle has their own payment rails. But then also, Circle is in testnet right now with their own blockchain. It's called ARC. And so that's going to be launching. This could be, and I don't think a lot of people are even focused on this on the institutional community, but they just talked on last earnings call around potentially launching a token for ARC. And that could be, in my opinion, massively valuable to Circle, because if you think about it, Circle is one of the biggest ecosystems already because they've got one of the largest stable coins. They're doing a ton of payments. They're doing tons of transaction volume. If they can drive some of that volume onto their own blockchain, big point. But then if they have their own token, that's going to be already probably out of the gates valuable. So the token, essentially, the way it would work is ARC right now is founded by Circle. The value of what generates revenues off of ARC, in theory, would go to Circle, the corporate entity. If they create a token, they could essentially create the business model where the token itself accrues the value off of whatever the tokenomics or the economic stream of the cost to operate and work on that blockchain. So if a lot of activity happens on ARC, in theory, that means ARC's token would be getting used quite a bit, which likely would drive more demand for that token. So if Circle creates a token out of the gates that has substantial value because people are saying, hey, Circle's got this huge ecosystem already, we can equate it to other ecosystems where they have a token and those are worth tens of billions of dollars in theory. If Circle owns a portion of that out of the gate, which they would, that would be value as in a sum of the parts. It would be valuable to Circle. But then on top of that, they could use that token to incentivize activity with USDC, so to accelerate the growth of USDC, but then also use the token to incentivize financial institutions and others, giving them tokens potentially to partner with them and use their blockchain. So essentially, you're using it as a carrot to drive network effects on your own blockchain. So I think could be very interesting. I think we're still like early days of from a regulatory perspective, can they do that to set it up? What would it look like? But these are this is where this space is so exciting because we're re-architecting the financial system in real time right now. And this, to me, this is like going back 30 years and going from paper to the desktop, or just we're electronifying, but the next generation of that, the financial system. And, there's going to be a lot of winners and potentially, a lot of, friction to companies by this happening as well. So it'll be very interesting. And I think that's, to me, what's so exciting about this.
Yeah, on ARC, that's it's too early to get a read on whether that'll be successful or not for that layer one that they're developing. Stripe also is developing a layer one as well, using for payments. And so I'm kind of curious with those two, and those I would argue USDC is probably the most resilient stablecoin that's out there. Period. I like it over Tether personally, and then Stripe is just a massive, very successful payment service processor. So if anybody can pull it off and really shift people over to layer ones, you would think it would be one of these two companies, maybe both. And so I was thinking along this line, part of the thesis for the Ethereum doing well, and of course digital asset treasuries built around Ethereum doing well, is payments and stablecoins specifically. Yeah. So if the layer ones for Circle or Stripe are wildly successful, does that really detract significantly from the Ethereum and digital asset treasury thesis, or is it not really that big of an impact?
Yeah, so it's a great question, and I think that you think about the equivalent of today's financial systems. There's a lot of winners, there's a lot of scale players, and so to me, Stripe and Circle scaling would just be validation of like this is a space that's going to be really big. And the fact that they're even like a Stripe is coming to it tells you that they see this opportunity and a lane for them to play in. So they will probably, like, I think those firms have, what's important, distribution. If you have customers, incredibly important. If you've got the regulatory know-how and a trusted brand, incredibly important. So having those, which both Circle and Stripe do, gives them a very strong position to be able to go to market. That being said, Ethereum's been already kind of in the trenches for a decade plus, winning network effects and building, there's huge applications that are happening on top of them. So, there's quadrillions. If you think about the amount of transactions that happen, quadrillions, like it's hard to even fathom the number. And that's what you're competing for, some sliver of that. So my view is there's a lot to go around, and big institutions that have network effects and lots of customers, trusted brands are going to be big players. You even think about like where some of the big traditional banks are going to be that have huge networks and customer bases and financial profiles to do that. Like I think there's like the game theory here is really interesting, but I do think that would be to me validating versus viewing it as like a big risk. I think if they're seeing traction, that means that Ethereum is also scaling kind of exponentially as well.
Yeah, I think that's fair enough. That's probably the most likely scenario. So I appreciate that. So let's talk two more names before we close out: Robinhood and SoFi. Robinhood first here. It's you've been consistently ahead of, I think, pretty much anybody else is covering this company and this stock. They made a major move last week with an acquisition of LedgerX, and of course partnering with Susquehanna for predictions markets as well. Some people, were kind of questioning and wondering whether or not they would actually go this direction away from Kalshi. So what are your high level thoughts on that partnership and where Robinhood goes from here on predictions market?
Yeah, sure. Yeah, and I actually had lunch yesterday with Shiv Verma, who is the next CFO of the company. So as you can imagine, prediction markets were pretty topical, and give you some kind of real-time thoughts on that. So I think the punchline is we figured they would eventually vertically integrate, and it's very on brand for Robinhood. So, starting into prediction markets, you want to get in quickly and gain proof of concept and product market fit. And that's oftentimes best to do and easiest to do with a partnership. And so that's how they initially started in prediction markets, which really were for effectively nothing a year ago. But as we've gotten some regulatory clarity and as the market's starting to develop a little bit, it became increasingly clear that this is going to be potentially a very material business for Robinhood. And just by the way, in numbers, went from essentially 0 to, if you run rate the November contracts, which were 3 billion contracts, that's nearly a $400 million run rate revenue business. So this is the fastest scaling business at Robinhood ever. And that's roughly 10% of their revenues. And we are in the first couple of innings of probably where this goes. It's starting in sports, and I think sports are kind of the gateway to getting people understanding how prediction markets work and getting them engaged with prediction markets. But I really think that this is a much bigger market. This is going to be a market where institutions come in, and just like the derivatives market's like $700 trillion. I think prediction markets are going to be a big part of something that looks similar to the derivatives markets, where it's in a way to express a view of risk in a very binary way. Whereas if you buy an option, you may have a view of what you're trying to express in buying that option, but there's also numerous other aspects of that investment that you may be right. You think the Fed's going to cut rates, and the option, on the underlying stock should do something, and it goes the opposite direction because there's all these other cross-factor risks. So having the prediction markets as a way to kind of express that view in a very specific way, I think is going to be a massive tool for institutions, not only directly, but then as you think about institutions, quant funds and macro funds, and they build these into their models, and then it becomes a trigger for making trades. This gets to the point of what Robinhood's doing here. Now you own, they're doing north of 50% of Kalshi's volume. So they kind of drove the activity anyway. So moving it onto their own exchange gives them a lot of ownership of several things. It gives them ownership of the economics. So they get to decide how they want to charge. it gives them ownership of what the product is, so ultimately what markets they want to run and not run, and lets them get to the market faster. So with Kalshi, they're already giving them recommendations of what types of markets their customers want, but that's an intermediary in the middle of it. Now they will directly do that. But then what it also does is it gives them essentially an ecosystem that brings in not just their customers, but as they build liquidity on this exchange, now Robinhood can start to interact with other institutions, interact with market makers. So just like buying Bitstamp on the crypto side was a gateway into getting access to institutional investor clients, this will expand that because institutions are coming to prediction markets. So they will be working with Robinhood on this. And so ultimately, the back end is going to become more commoditized. Like being an exchange to me is not the value add. What's going to be valuable is which exchanges build real liquidity and have the most customers on them and the best customer experience. And so that's where Robinhood's going to compete. But now they own the full chain of that, not just the front end of it, which was effectively what they had up until now. So the point is, we're in the early innings. Now Robinhood's going to have a full ecosystem. The economics are going to go up pretty materially, in my opinion, because they don't have to share them, and they can also play around with the economics, and then also gives them access to a lot more customers that will want to use Robinhood's exchange, in my opinion, because they will immediately have more liquidity than virtually anybody because they are already driving so much of the volume. They're roughly a quarter of all transactions that happen in prediction markets today.
Right. And yeah, I love the piece that you mentioned there too on the institution side of it, where it's like, they're buying it because in-house, like it makes sense, economics already. But, Vlad talked about in the Fireside, I don't know, 5 or 6 months ago, the institutional volume of like an IBKR and so forth. Like it's about half of what they have on their exchange. Of course, Bitstamp was their first institutional facing product. So a lot more to come. So plus it might be something that helps them scale internationally as well. A lot of the markets that they're in are more of I would say a betting culture rather than investing culture, which hopefully that changes over time as Robinhood makes an impact. But so with Robinhood specifically as well in predictions market, though, the other side of this is there's been some regulator pushback, I think increasingly so towards Kalshi, although Polymarket did get entry into the United States. So does this expose Robinhood to more regulatory risk, and how do you assess or perceive that?
Yeah, so our view is that this will get figured out over time, especially as institutions come, and it's just, again, so this is a frontier, kind of like crypto, frontier asset class that's in the early days of figuring it out, and the technology is actually a little bit ahead of where the regulatory system is. Like there's a lot that actually still needs to get figured out regulatory wise, but like the problems that need to get solved, in my opinion, aren't all that complicated because there's a lot of parallels to traditional assets. And so this will get figured out. A lot of the cases right now, state by state, are around sports betting. So that's, to me, sports will always be a part of prediction markets. But
sure,
I think Robinhood has a good analogy. It's like the newspaper. Sports are one page of the newspaper. We think prediction markets are going to apply every page, the business section, the style section, there's going to be prediction markets around everything. And the part that's going to grow the most will be parts that have economic implications, that have market implications. So markets around, is this company going to beat earnings or miss earnings? When you go buy a stock, you think the company's going to beat earnings and the stock goes down. You say, well, what the heck was that? Well, you didn't really know what people are betting for in the stock. The prediction market's just a binary. If you get it right, you get it right, and vice versa. And so there's both a direct exposure on it, but then there's the signal. If people think that this company's going to beat earnings and it's being priced at 75%, maybe there's other stocks that would want to buy also. So I set up trades that connect to that initial market. And so I think that's where we're going to go. The regulators are going to figure this out. To your point on global, I absolutely agree with that. I think that globally, there's also it's piecemeal regulation right now. You've got MiCA, which is I think constructed, but then you have the FCA in the UK. There's all these different regulators that are still trying to understand, and I think are at different places of enthusiasm for the market. But ultimately, I think that again, like the institutional investors are going to want this. They're going to find ways to bring this market to look similar to other more traditional asset classes. And I think Robinhood is really well positioned for that because they're really good at understanding both the frontier technologies, but then also how do we do it in a compliant way and deliver it for our customers in a way that also protects us. And I think that's the way they're thinking about this as well.
Yeah, absolutely. Also with Robinhood, as far as the yes no event, it's a predictions market event. It's an AI event on December 16th. Fourth event of this year, kind of a surprise. They seem like they constantly like to surprise at least me. Any expectations for that event?
It's a good question. They didn't market it, I would say, as much to the sell side or to probably investors. So I kind of feel like this isn't on the same plane in terms of like what they're going to be unveiling. But I just start there. Like I'm not going to the event. And I don't think they've kind of built it up in the same way. So I just put it there. That being said, like AI is going to be such a big deal for their business. I know we're going to talk about SoFi. I think these are firms that like AI is becoming integrated into financial services. We're at the very early stages of that as well. And the firms that understand this and know how to integrate these technologies, it's going to speed them up at a rate that the incumbents are not, right? So if you think about like technology shifts that have happened over the last several decades, whether it's going from branches to everything's happening on computers to mobile, these things all happened over years, and it took multiple years to really kind of get to saturation. Like AI is developing at such a rate of change that companies that are integrating it today, their models could look very different by 2027, 2028. And that's going to speed them up relative to the competition that is not as forward-leaning or just not as innovative. And so like Robinhood, I mean, they're already using it in a lot of ways around their expense structure. Part of the reason why Robinhood's been able to, the velocity of launching products at such a speed and keeping their expenses effectively contained or flattish on a core basis. AI is a big part of that. How they market. One of the things that we talked to Shiv about yesterday is kind of the dynamic marketing, and so their ability to underwrite customers at a customer by customer basis and give them offers where your offer, Roy, may be much better than mine that they, for your assets, because they can see that your asset yields are more productive, so they can underwrite that to a higher ROI or a faster payback, whereas they see that I'm sitting in slower moving assets and I'm not turning them over. So the ability, my incentive to bring more assets over may not be as high. So they've got so much data, the ability to market in a customized way is differentiated. I think you'll see that in their customer acquisition. But then in terms of the customer facing, the ability to take people that really are less sophisticated in trading and give them tools and the ability to write code as an example, but not really, how do you program something with AI if you're not even a programmer to help express views on the market or trades? They're kind of abstracting away the complexity and delivering that. And AI will be a big part of doing that for their customers. And ultimately that will differentiate the platform, but it will drive more transactions per customer with both active traders, but less active traders. And then a big thing I see coming here is using AI in advice. And there's still, from a fiduciary standard, there's still some regulatory questions around how exactly we're going to do this. But I think, SoFi's self-driving money and Cash Coach, I think, are good examples. Like we wrote a report back in 2018 talking about, so like 8 years ago, talking about how we're going to these super apps, and AI is going to help lower the bar for people that can get access to kind of a full suite of customized real-time optimization of both their assets and liabilities, and how artificial intelligence will help drive that. Because with AI, it can just be doing it in the background. So if you have cash sitting at some bank and you're getting 5 basis points, and you can sweep it over to a different account and get 4%, if your AI agent's doing it for you automatically and sees that inefficiency is there on the asset side of your portfolio, it can do that. If you're paying these fees for something that are detrimental to you, it can do that. If you're paying 25% on your credit cards, but you can consolidate to some other type of product,
Right.
it can either offer that to you or do it for you. So all of these things that you take a human to do today, AI in theory in the future should be able to do for you. And I think we're progressing towards that world. And firms like Robinhood that both understand how to use data, but also are going to understand how the technology can be powered for their customers, they're going to integrate it in ways that I think will be adding entirely new legs to the stool for them and on the revenue side. And so I think Robinhood's well situated for that. SoFi really well situated for that as well, because they've got the products, they've got the customers, and they understand the technology.
Yeah, it seems definitely like it's something as a flywheel driver. And so with SoFi, you mentioned that Cash Coach as well, newer name that you're covering. I'm kind of curious if that is a big part of the reason what got you into SoFi, if it's the AWS of a fintech thesis, and your thoughts on that, or what specifically led you to cover this name that is attractive as far as SoFi.
Yeah, so I've known them for a long time, like way before they were public. I'd gone in and met with them and spent time with them, and followed them since the SPAC 4 or 5 years ago. So this wasn't a new name in any way to us. There's always a little bit of just trying to divide and conquer on resources and the ability to cover new names, and it takes time as an analyst and building the models and the expertise and talking to clients. But it was clearly a name that I think interest is there around, and their success in the public markets already, I think, is validating to where they are. But I also viewed it as, when we came out on the company in April formally, it was at $12. And to me, it was getting kind of this punitive valuation where, there is an economic exposure here because it's a lending model. They are transitioning to more of a fee-based capital model. But, I think that people are being overly punitive on it and not giving them the benefit of like the growth that's happening there, but also the unit economic differentiation that they have that is the flywheel that's accelerating for them, that will essentially scale their earnings much faster than their top line growth. And the top line growth is, accelerating as well. And so, I viewed it at $12 as like, this is a company where you can underwrite the downside risk really well. And the stock doubled in, I think, a little bit over 2 months from us picking it up. Now, when we launched on it, we said we think fair value is like mid-20s. And, that was based on a view that the company could get to about $1.75 in EPS by 2030. And then if you discount that back, you get to like a mid-20, you pick your multiple, but you get to probably like a $40 share price, but then you have to discount that back to today. And that gets you to like a mid-20s net present value. And that was kind of our framework. A lot of sell side, I think, is very short term, and buy side too. They're looking at like what's happening this quarter, the company worth on today's earnings. That's why I'm saying, where are they going to be in 3 or 4 years? And if they can get to $1.75 or $2, this is a much more valuable company. Now, that doesn't mean it's going to be a straight line or there's no risks along the way, but I think the risk reward was tremendous. Mid-20s, which the stock got to when we downgraded it, we felt like, okay, let's take a little bit of a breather here. Let's reassess this because they're now in the zip code of what we felt like was fair value. Now, I would say, they are still executing at an incredibly high level. And obviously, just last night, they did a capital raise. And I think there's questions around what is that? My view is this is why they're a public company. You're a public company, so you have access to capital to grow your company at as fast as a rate as you need to. And I think to me, that's what this is. They were just at a conference a couple of days ago, effectively, in my opinion, confirming the near-term outlook is good. Talking about fourth quarter, really they had an opportunity to probably talk down fourth quarter, which they didn't. An opportunity to talk down next year, which they didn't. So my view is, as far as they can see, business is in a great shape. But actually, because there's so many moving parts right now in this space, and the growth is so powerful, and there's so much up for grabs, whether it be tokenization or AI or money in motion, like now is the time to do something. So my view is there could be acquisitions coming here, and so you need more capital for that. You need more capital to just fund the accelerating growth profile of the company. And then there could also be, if you recall, a few months ago, there were some headlines around the Treasury or the U.S. potentially selling some of its student loan exposure. So could there be capital needed to participate in that? I don't know any of these answers because just occurred, so I'm seeing it like everyone else here. But I do think that, I know that initially kind of you see a knee-jerk reaction on the stock. That's just simply absorbing the new shares and the discount. But ultimately, if you're a long-term holder, these are things that help accelerate the growth profile, assuming it's not plugging a hole for an issue. And I think we just heard from the company literally 2 days ago that there's no issue. If anything, things feel really good. So I think, my view, investors should feel good here. We're reassessing the valuation view, reassessing the growth profile. On my numbers, the company's trading at a little bit over 20 times 2026 EBITDA. I think that's reasonable. Could it be a little bit higher? Perhaps. But for a company that is still somewhat balance sheet intense, that's a nice multiple, even for the future growth. So, that's kind of where we are now on it. But I would say incredibly impressed with the growth profile. And then I think they have a right to win in all these areas. Our entire conversation here for almost an hour has been around tokenization of markets and where these new technologies are going. The AWS of fintech. I mean, they're in the mix of all this, and they've got 13 million customers. So they've got big distribution. They've got a big balance sheet. They own the value chain. Being a bank, they can own all the economics of all this. I think their mortgage product is going to be a huge growth driver. From here, it's been effectively nothing, but you're going to see that explode over the next couple of years. Student lending is going to become bigger again. Obviously that was the company's roots, but you're going to see a big acceleration there. So I think there's a little bit of a handoff happening here. And then I would like to see them be bigger in brokerage. I would like to see them be bigger in crypto. And these are areas I think they're addressing. And those are also areas that I would not be surprised to see M&A. Do they buy a self-directed broker to gain both customers but more capabilities possible? Do they buy something in the crypto sphere to get more connectivity into payments or into tokenization?
Well, one last question on SoFi, if I could, on crypto specifically. How so? Of course, they're rolling out their own stablecoin, SoFi USD. They've talked about getting in payments in crypto specifically, relaunching the Crypto Invest platform, a couple other pieces as well, tokenizing deposits, those sort of things. How significant a piece is crypto to the thesis for SoFi in the future?
Yeah, so I mean, my current view is it's going to take time. So I'm not expecting hundreds of millions of dollars of revenues in year one. But in terms of, it was a missing piece. So when they had to get out of crypto buy and sell, that put them at a disadvantage. So banks were not allowed to offer buy and sell to customers. So when they got their bank charter, they had to exit. So that put them at a competitive disadvantage to acquire customers, right? Because younger customers in their demographic that want a full suite of brokerage products, if you don't have this one product people like, that doesn't help. So getting back into the game there will be additive to customer acquisition for them in brokerage, but then also, could be tens of millions of dollars of incremental revenue quickly. Same thing, stable coins. So you kind of have all these pieces that, in my opinion, can be tens of millions of dollars. As you get to a world of tokenizing all other types of assets, when SoFi has, again, 13 million customers and growing, they've got products. So as you think about assets moving on chain, they're generating loans. They have assets, they have deposits, they can tokenize all these. So there's spreads in actually the functionality of tokenizing. There will be spreads in custody, and then there'll be spreads in the transactions of all these assets. And so, in my opinion, they've got a right to win. So as this asset class, I think, grows exponentially, and in 5 and 10 years is 10x or even could be much more than 10x larger than it is today, they will be a big player there. So it will go from tens of millions to, in theory, many billions, but also they become one of a smaller subset of financial institutions that understand the legacy financial world and the regulatory world that is critical. Robinhood's the same way. But then also, how do you integrate that legacy world of financial services into this new world of financial services that's integrating these technologies like blockchain and AI, but doing it in a compliant way, in a safe way, in a way that abstracts away the complexity for customers. And that's ultimately, I think, where we're going. It's not going to take months. It's going to take at least several years, but they're, I think, in a very strong position to compete there.
Yeah, and it's a good value proposition for them. And so last question, we talked about a lot of names. You cover a lot that we haven't talked about. So out of everything that you touch, everything that you cover, what do you think is the most misunderstood stock by the market?
Yeah, I would say, one that I think is very interesting here for the next year is eToro. It's not been a great stock. They came public in the middle of the year, and I had a big kind of run out of the gates, and then kind of moved lower. And part of that was just some of these IPOs that had big pops. Then you have unlocks happen, and you get this like liquidity of just as liquidity opens up, you get selling. So, and then you get shorting, institutional investors also short them. But when I think about companies, and then on top of that, they came public, crypto started to roll over a little bit, and they have a little bit more leverage to crypto than some others.
Yep.
When I think about, and they're more international based, but when I think about these themes of like, where is the puck going? Who is really positioned for the future of brokerage and banking and financial service infrastructure? I'd put eToro in that bucket as well. So their CEO is an engineer by background, just like Vlad from Robinhood, similar roots. Very like they had a Bitcoin strategy before most. They were buying Bitcoin back in like the mid-teens, and then they took it off their balance sheet. That would have been worth billions of dollars. But they were, just the point is like very early. But I also think like very much like, how do we do this in a compliant way? How do we, jurisdiction by jurisdiction, because they're outside the U.S., understand the regulatory needs and do it in the right way. But that's very hard for firms to replicate because they have the boots on the ground. They've set themselves up. And so now the company is trading at, Robinhood's trading at 35 times my 2026 EBITDA estimate. And eToro is less than 10 times. eToro has over $1 billion of cash on its balance sheet. So remember back to Robinhood was trading like $10. Yeah. And our argument was kind of hit people over the head. Like, you can buy Robinhood, this great company, at almost cash value.
Yep.
eToro is almost the same thing today, where you're buying this company that, they're not Robinhood yet. And I'm not saying they're necessarily going to be Robinhood. It's different. But they are building all these other facets of the business model. They're behind. But they've got the know-how in blockchain, crypto, AI. Like, they are more AI centric than almost anybody. Like, they are driving, I think 60% of their code internally is being written by AI today. So they're one of the companies I would bet on to say they're going to figure this out. They're going to be much bigger. They've got a huge balance sheet too. They've got a lot of money to go buy some interesting companies. And so I would expect them to do some things. The copy trader product, I think, is innovative and different. And I think that's something that separates them outside the US, and they'll be doing more with that in the US once we get some regulatory clarity. But I would maybe flag them as, we've got a $90 price target on a stock that is, in the more mid 40s. So that would be another one that I think is smaller cap, but it's going to be a little bit levered to crypto from here. But I do think over the next year it could be very interesting.
Yeah, I appreciate that. I've read your notes on that, and I actually looked in some in eToro just because you were starting to cover it, talking about it, and that actually gives me a lot more to look at too. So, Devin, I really appreciate your time and coming on, answering these questions. If you guys are watching this and you enjoyed the content, Devin Ryan's, he honestly is one of the best analysts out there. I know he probably can't look at tip ranks, look him up. He's like top 10. I think he was number 7 last time I looked. He is on X as well. I'll put his handle. He only has 1,500 followers. Well worth following. Great interview with Shiv, by the way, the future CFO of Robinhood. Any last words, Devin?
I think this was great interview, Roy, and enjoy everything you're doing as well. And it's fun to do these types of interviews and talk to your audience. And we should do it again soon. I think there's just so much happening in the ecosystem with obviously the companies, but just infrastructure, legislation, regulation, and things are moving quickly. So it's going to be a fun year ahead, and would love to come back and revisit some of these themes.
Yeah, with a lot of these names, it feels like 5 years that we've experienced instead of just one over this last year. It's crazy.
So, it really does. Yep.
All right. Well, thanks for your time, and thank you, everybody.